Okay, welcome to the deep dive. Today we're digging into a pretty specific source. It's a newsletter all about the Indian stock market, giving us the picture as of, what, June 15th, 2025?
That's right. And it's really dense with data. We're talking valuation metrics, historical trends, even their own forecasts and sentiment notes.
Yeah, and our job here is basically to cut through all that noise, pull out the really key insights, the stuff this source really wants you to notice so you get the informed view without having to wade through, well, everything yourself.
Exactly. Think of it like the highlights reel, what the source says about where the market is now, where their models think it's going, and the general feeling they're picking up.
Perfect. Let's jump right in then. What's the very first thing this newsletter flags up about the market situation on June 15th?
So it kicks off with the raw numbers, key valuation and momentum parameters, and it compares them to the week just before June 8th.
Okay, let's get into that. What actually changed week on week according to their numbers?
Well, first up, the nifty PE ratio, or price to earnings, gives a sense of how pricey the market is. It dipped just a bit, from 22.5 down to 22.2.
Okay, tiny dip. What about PB, price to book?
Similar story there, also down slightly, from 3.7 to 3.6.
Right, so maybe a marginal cooling off on those two key valuation metrics. Anything else?
Yeah, the market cap to GDP ratio, that's often seen as a bigger picture valuation measure for the whole market against the economy. That also came down. It was 123.51%. Now it's 119.81%.
Okay, so valuation's easing back a touch. What about things like momentum,
Sure.
RSI?
Now the RSI, the Relative Strength Index, that actually saw a pretty noticeable increase. It went from somewhere around 53.6 or 55.25 up to 65.
65. So generally anything over 50 suggests upward momentum, right?
Mhm.
And heading towards 70 often means stronger buying.
That's how the indicator's usually read, yeah. So
Yeah.
a definite pickup in momentum, according to that.
And volatility. What did the India VIX do? That tells us about expected swings.
The VIX also went up, not drastically, but
Yeah.
up from 14.63 to 15.08.
Okay. So rising VIX often means people are expecting choppier waters ahead.
Generally, yes. It signals increasing expectations of future volatility.
And where did the actual Nifty index end up in the middle of all this?
Right, the Nifty itself closed at 24,718.60 on the 15th. That was down from 25,003 the week before.
Down a bit. And they note the 13-day moving average.
Yeah, the 13 EMA. It was 24,750 the prior week, and now reported at 24,863.
Okay, there's one number here, looking at the comparison, that really kind of leaps off the page. The FII net open interest change. That's foreign institutional investors, right? What's the story, though?
Oh, yeah, this is where it gets really interesting. According to the source, there was a huge swing. The previous week, FII net open interest was positive, plus 1,010.
Okay.
By June 15th, it flipped to negative 12,264.
Wow, that's quite a reversal from net positive to net negative in just a week.
Exactly. It points to a pretty substantial shift in how these big foreign players were positioned, at least according to this specific data point in the source. A move from a net long or positive stance to a net short or negative one.
Okay, so let's just wrap up this first section. We've got slightly lower valuations on some key metrics, but increased momentum via RSI, higher volatility expected via VIX, the Nifty index itself dipped a bit, and this really striking negative shift in FII positioning. That's the snapshot.
Mhm.
Now, the source doesn't just look at the now, does it? It tries to look forward using a particular model.
That's right. The newsletter talks about using what it calls the original Buffett indicator model. They use it to try and project potential future returns for the Indian market.
The Buffett indicator, right. Usually market cap versus GDP gives a sense of overall market valuation relative to the economy. So how does the source use it, and what's the prediction?
So their application of this model leads them to predict an expected annual return of 6.3% per year for the coming years.
6.3%, that's very specific. Does the source break down how they arrive at that number? Like, where does that 6.3% come from?
Yeah, they do. They break it into three parts. First, economic growth in local current prices. They see that contributing 6.86%.
Okay, growth driving things.
Then, dividend yield. That adds another 1.53%.
Right.
But then there's a drag. They call it valuation reverse to the mean. That actually subtracts 2.1%.
Ah, okay. So the model assumes current valuations are a bit high compared to the historical average and expects that to pull returns down slightly as it, reverts back.
Precisely. The idea is that growth and dividends push returns up, but the starting valuation pulls them back a bit, landing at that 6.3%.
And you mentioned there was a modified model in there too.
Yes, and interestingly, it comes out with the exact same expected return. 6.3%.
Really? Same number?
Yep. The growth and dividend parts are the same. The valuation reversion bit is just fractionally different, minus 2.11% instead of minus 2.1%. So bottom line, whichever flavor of their model you look at, this source lands on 6.3% expected annual return.
Huh. That consistency is definitely worth noting. Okay, so 6.3% is the forecast based on their methods. Now, moving beyond the hard numbers and models, what about more qualitative stuff? What does the source say about market sentiment or where investors should maybe focus?
Well, in their notes section, they talk about positive sentiments, and they seem to link this to new SIPs and STPs coming in.
Right. Systematic investment plans and systematic transfer plans, people putting money in regularly or moving it around. So what's the source's take on that?
They basically frame it as indicating that it's a time to accumulate in such zone.
Okay, so they see these flows as a sign that the current market level, despite maybe the recent dip or volatility, is actually an opportunity for investors who want to build positions over time.
That seems to be the interpretation presented, yeah. Linking investor behavior to a potential strategy.
Interesting. Does it get more specific, like what to accumulate?
It does. It explicitly states the current focus should be on large cap funds and hybrid funds.
Large caps and hybrids. Okay. Any specific sectors?
Yep. Current sector focus is listed as banking, finance, and defense.
Banking, finance, defense. Got it. Okay, so we have the current picture, the future projection, the sentiment, the focus areas. Let's maybe zoom out a bit now and look at the history. The source includes some historical trend analysis, right? Tracking nifty signals over the past few years.
Yeah, and this historical trace is, well, it paints a picture of quite a bit of chop, as seen by this source anyway. It shows a whole series of trend shifts. Going back, they note a negative trend, starting way back in January 2022.
Okay, and how did things unfold from there, according to their signal?
It's a real back and forth. You see positive signals pop up, then turn negative or neutral again, sometimes just months later. They list negativity in late 2022, then a positive turn in April 23, then a sort of negative medium-term signal in August 23, back to positive in September 23, then negative again in October 23. Then it seems there was a longer positive run noted from November 23 through late 2024.
So quite a roller coaster, even before we get to the really recent stuff. What happened as we got closer to the present day in the source's timeline?
They flag a negative trend starting December 2024. And they say that basically continued, no reversal seen, until March 21st, 2025. That's when the trend flipped positive again.
Okay, so positive in late March 2025. Did that stick around for long?
Not really. The note says after a positive close the week before, the Nifty closed negative on April 4th, 2025. And the trend was called bearish in short term from that date.
Another quick turnaround, and after that?
Trend turned positive again after April 18th, 2025.
Man, so even just in early 2025, based on the source's tracking, you had positive, then a quick flip to negative bearish, then back to positive again, all within roughly a month.
That's what the historical notes suggest, yes.
What does that kind of history tell you then?
Well, it really underscores the volatility, doesn't it? The rapid shifts in sentiment or price action that the Nifty, or at least this source's interpretation of the Nifty's trend, has gone through. If you were relying purely on these signals, you'd been changing your outlook pretty frequently.
Yeah, sounds like it. Did other parts of the market mirror this choppiness? What about small caps or mid caps?
That's an interesting point they make. The source specifically notes that the Nifty Small Cap 100 and the Nifty Mid Cap 150 indices actually stayed positive through some of those periods when the main Nifty trend was flagged as negative.
Oh, okay. So suggesting maybe different forces were at work in the mid and small cap space compared to the large cap Nifty 50 or Nifty 100 during those specific times.
It certainly implies that, yeah. Provides some useful context.
Definitely. Okay, let's wrap things up by looking at the detailed sector data they provided for June 15th itself. What does that breakdown show us across different market segments?
Right, so the table gives a snapshot of various indices, things like their last close price, the percentage change for that day, and for June 15th, a lot of them were actually down on the day, and crucially, their current PE, PB, and dividend yield figures.
Let's focus on those valuation metrics, PE and PB. How do they compare across different company sizes? Say, Nifty 100 versus Mid-Cap 100 and Small-Cap 100.
Okay, so the Nifty 100, which is your large caps, shows a PE of about 22.14 and a PB of 3.67.
Right.
Now, compare that to the Nifty Mid-Cap 100. Its PE is way higher, 32.73. and the PB is also higher at 4.96.
Wow, quite a jump. And small caps.
Similar story for the Nifty Small Cap 100, also higher valuations than the Nifty 100. PE there is 32.26 and PB is 4.43.
So based on this data from the source for June 15th, the mid and small cap segments were trading at significantly richer valuation multiples, both PE and PB, compared to the larger companies in the Nifty 100.
That's what the numbers show, yes. A noticeable valuation gap.
And just checking back on that volatility indicator, the VIX, for that specific day, June 15th.
Yeah, the India VIX closed at 15.08, as we said. But the table highlights its change just for that single day was a positive 7.59%.
Almost 8% jump in one day.
Yeah, a significant move for a single day. It really reinforces that weekly increase we saw earlier and underlines that on that particular date, the expectation of volatility was definitely elevated according to this source.
Okay, right. So we've really taken a journey through this newsletter, haven't we? Pulled out the key bits it presents. We started with that weekly data snapshot, the shifts in PE, PB, market cap, GDP, and especially that big swing in FII positioning and the rise in the VIX.
And the core metrics.
Then we looked at their specific forward guess, that 6.3% annual return based on their Buffett indicator model and how they broke that down.
Right, the growth, dividends, and that valuation drag.
We covered the positive sentiment they noted, linked to SIP and STP flows, and the focus areas they suggested, large cap, hybrid funds, and those specific sectors, banking, finance, defense.
Yep, the qualitative overlay.
And finally, we stepped back to see the historical context from their nifty trend signals, showing all that recent choppiness and rapid shifts, and then drilled into the latest sector data showing those valuation differences, especially higher multiples in mid and small caps.
It's a detailed, though obviously very specific perspective on the Indian market at that point in time. It draws on different types of analysis, fundamentals, technicals, sentiment.
So bringing it all together, what's maybe the big picture thought or question this particular source leaves you, the listener, with?
Well, I think it raises a really interesting point to think about. On the one hand, the source puts forward this model projecting a, let's call it modest, 6.3% annual return going forward, based on fundamentals like growth and valuation reversion.
Okay.
But then in the very same newsletter, you have all this data highlighting recent, really quite rapid shifts in market trends, that big negative swing in FII positioning we talked about, and these notable jumps in expected volatility shown by the VIX.
Right. The model predicts one thing, but the current conditions and recent history look pretty dynamic, even volatile.
Exactly. So the question it really prompts you to ask yourself is, how do you square that circle? How do you reconcile that specific 6.3% forward projection with the source's own evidence of a market that seems, at least recently, characterized by quite a bit of volatility and these quick changes in key indicators?
Are those signals sending the same message, or is there maybe a tension there that you need to weigh up when you're forming your own view of the market?
That's the crux of it. Thinking about how that piece, predicting future returns, sits alongside the evidence of present volatility and historical chop, all coming from this one source that's probably the key thought to mull over from this deep dive.